Welcome back to Women in Finance. Today, we are continuing Module 4, Section 5 on how to value a company. Previously, we discussed the market-based approach. So let's move on and discuss the other approaches, starting with the peer-based approach. The peer-based approach of valuing a company involves benchmarking a business against other similar companies of the same size and nature. It is also called the ratio method because it uses key performance indicators such as the price-to-earnings ratio, price-to-sales ratio, dividend yield, and more to help evaluate the value of a business. If the businesses are extremely similar, then a superior business should have a higher value compared to its peers. Here is an example of what a typical evaluation sheet would look like. Now let's move on to the third approach of valuing a company, the cash flow approach. Let's start with the discounted cash flow method, or DCF. This method estimates the value of an investment based on its future cash flows. The idea is that the value of an investment is equal to the present value of future cash flows, discounted at a rate that reflects the time value of money and the risk associated with the investment. So, by estimating future cash flows, selecting a discount rate, and calculating the present value of those cash flows gives us the current value of the investment. The DCF method is forward-looking, making it useful for valuing assets which have uncertain or variable cash flows. However, the DCF method also has its limitations, such as the difficulty in predicting future cash flows or selecting an appropriate discount rate that reflects the risk associated with the investment. An important principle in estimating shareholder value is the time value of money. This concept asserts that money today is more valuable than money in the future. Techniques like discounting and compounding are used to account for the time value of money. Discounting refers to the process of reducing the value of future cash flows to their present value by applying a discount rate that reflects the opportunity cost and inflation. Compounding refers to the process of increasing the value of an investment by earning returns on the original investment plus any accumulated interest or other returns. Now let's look at a simple DCF-based valuation model, starting with the example of a boat that has a 5-year lifetime. First, we track the cash flow that the company can generate in 5 years. Then, we discount the cash flow using the cost of capital to get its current value. This is the sum of future cash flows discounted to adjust for time value. And with that, let's move to the fourth and final approach to valuing a company, the dividend approach. The dividend approach utilizes the dividend discount model, which calculates the value of a company based on the present value of its future dividend payments. The basic idea of the DDM is that a stock's value is equal to the present value of all the future dividend payments that a company will put out, discounted at an appropriate rate. The DDM assumes that a stock's value is determined by the expected future cash flows in the form of dividends. The DDM is calculated by estimating the future dividends that a company will pay out and then discounting those dividends back to their present value using a discount rate. It is useful for valuing companies with historically stable dividends, but it assumes that the companies will pay the same dividends in the future. We hope that with this lesson you have a better understanding on the different ways to approach valuing a company, because these valuations are essential for making informed investment decisions. Until the next lesson, happy investing!